Now let's bring in our panel. Solis's Dan Greenhouse, Requisite's Bryn Talkington, and Capital Area's Malcolm Ethridge. Both Bryn and Malcolm are CNBC contributors, one and all. It is great to have everybody. I guess the big question, Dan, I'll begin with you since you're sitting here next to me, is if there's a resolution reasonably quickly, what do you do as an investor? You just go back to playing what you were playing before, the idea that, hey, earnings are going to be pretty good, and you still have this stimulus coming out of Washington, and all's well again?
I think the temptation will be to do something else. I don't know if that's correct. It might seem to many to be too simplistic to say, well, we're just going to return to the world as was. And admittedly, in a lot of respects, we will not. Oil is not going back to $60 anytime soon. And the exact mechanism by which this is solved remains to be seen. But from an investment standpoint, we've talked ad nauseum, as everybody has noted, that earnings expectations have held in quite well. They've gone up in many cases. The valuations in a lot of those big names that have driven a lot of inflows into the market have gotten more attractive. Some are trading at sub-market multiples, which is insane when you consider the growth profiles. So I think that's probably not a bad place to start. But I do want to quickly note before we move on that the headline is that Iran wants to settle this. And I don't think anyone should be surprised they're getting bombed left and right. I'm sure they'd be perfectly happy to have this settled. But it's the condition. And listen, we talked last week. If and when there was something resembling a settlement, the markets would fly for all the technical and fundamental reasons that we've been talking about. But their conditions for settling this, so to speak, involve taking over the Strait, which is going to provide them a revenue stream, as Pippa noted, a promise never to attack them ever again, and a right to enrichment. A number of things that the U.S. is not really going to go for. So I get why the market's up so strongly today, but I would just caution investors, a lot of those conditions are probably not something that the U.S. is going to agree to.
Bryn, are you still cautious? Want to see more information before you make a larger investment decision here?
You know, I like to rely on technicals when the fundamentals are foggy because obviously we have this war, this excursion. So, you know, I've been talking a lot about the 200-day. There's a lot of good data, Scott, that if we can get back above the 200-day within the first month, then it's got a 100% hit ratio that a year later, stocks are positive with an average return of around 19%. So we're only about 2% below the 200-day. But so, you know, March 19th, we went below it, Scott. So I'm looking at April 19th, which is a long time away. But I do think that's really important to technically get back above that so we can build off of there. So that's the key item that I'm watching before I put on, let's say, like a bigger exposure, because it does have that really high hit rate a year out.
What about you, Malcolm?
Yeah, I think Dan's making a great point that we might need to curb our enthusiasm just a little bit. Nothing is set in stone, and this can all be undone with one tweet. But I also think today is a really good exposure of what the playbook probably looks like once we do get the all clear. So financials have done pretty well. The XLF participated today. Tech has done really well today looking at the NASDAQ. And those were the two sectors that lagged coming into this year. And so maybe that is the place that investors are looking at opportunities where things have been sold off quite a bit, and we can make some sort of intimation that maybe that's where dollars are going to flow the heaviest as soon as there is an opportunity to start buying back up this dip.
Dan, this was always the danger, wasn't it? That what was always thought to be, I suppose, and hoped to be a short-lived conflict, the danger was getting too negative as it seemed to be dragging on with no real credible information to go off of, but always knowing that in the background, this hopefully wasn't going to be a long-term ordeal.
Yeah, but listen, I never really thought it was, it depends on your definition of long-term. I think a lot of people of our age look at Afghanistan and look at Iraq and harken back to Vietnam and think that this is going to be multi-year.
No, but I think at the beginning, the administration's stance was whether it was believable or not in the sense of you never know what's going to happen once war begins,
of course,
was 4 or 5 weeks was kind of thrown out there estimate.
Yeah, I think most people I speak to seem to believe that the administration thought this was going to be a weekend thing a la Venezuela, and obviously that's not been the case. I don't know if that's true or not, obviously. But, yeah, there was a risk of getting too negative, but at the same time, a fully loaded Kuwaiti oil tanker was hit with a drone last night.
Yeah, and the market's still open positive today.
Yes, I guess.
Right?
I'm not making a market comment. I'm just saying hostilities have not ceased, and we talk about getting more negative. Getting back to my point about the conditions that the Iranians are going to demand, so to speak, for cessation of hostilities, if the U.S. doesn't agree to them, the risk becomes, well, we're going to start targeting the regional infrastructure to a greater degree. I don't know whether the U.S. is actually going to go bomb civilian infrastructure in Iran, but Iran could bomb other refineries throughout the region, could make this a little more painful from a global standpoint. And so yeah, I get it, the risk is getting too negative, but the negative risks were also quite real.
It just, Bryn, I mean, it doesn't really behoove either side to draw this out. Obviously, from a military standpoint, there's no competitive conversation to be had regarding the Iranians versus the United States. And from our perspective, you know, an environment in which oil prices are going to remain elevated over an extended period of time, and thus gas prices, which went over $4 a gallon today on average for the first time in a while, we're going to remain elevated over a period of time where the stock market was going to get hit to a degree that I don't think anybody, certainly not in Washington at 1600 Pennsylvania Avenue, would like to see. This thing was always deemed to be, let's not let it drag on too much. It's just as the market's in the fog of war, it doesn't necessarily know how to assess all of that.
Listen, when you have the U.S. and China, which is what, 2/3 of global GDP. It's like the only real countries from an economic powerhouse that matter. I think that China-Pakistan is incredibly important. China buys 89% of Iranian exports. And so I think that them coming and negotiating with Pakistan, we'll say alongside the U.S., this feels like this is going to end, by the way. And I think that is what's happening today, is that China is a game changer. And so we are going to defeat this one way or another. But to me, that was the best news today, because China needs that oil and they need the Strait of Hormuz open. And they're not going to be wanting to pay the Iranians a toll booth. By the way, that's absurd.
Sure.
Going forward. So I think that's a really big deal today with China entering this.
If you say that this feels like it's going to end, that was the comment you just made. Mm-hmm. I mean, that sounds like somebody who may be looking to put some opportunity to work. No, if you believe that, are you going to wait until you see signed a ceasefire, or are you going to act accordingly based on the assumption that you're making today?
Yeah, well, I mean, we're already invested, right? First of all, we didn't sell anything. That's the key thing. I mean, listen, I think Google here, up almost 5%. Google, CBRE, Capital One. I mean, these stocks are off 20% from their highs, or 20% year to date. So, I mean, to me, those are three great places that I would happy to put the money to work today, and then add more. But I do want to say, I want to get above that 200-day moving average. Nothing good happens if we stay there more than a month. So I'm really just balancing today's news of China, which we don't know the details, with the reality that we need to get back above that 200-day. There's so much history what happens if we get back above it versus stay below it more than a month.
I understand that the technical confirmation, I guess you need to see, and that's completely understood. Speaking of stocks that are bouncing a lot, what a move for NVIDIA today. After that company announced a new investment with Marvell. Christina Partsenevelos is here with that. You told us the other day that you were so closely watching the $170 level. Well, it took a deal with Marvell. It took comments on this network from Jensen Huang, and then a better overall environment to move the stock now well above that level.
Yes, I think the better environment is really a big driver, especially because ETF trading right now is just a huge portion. So many people are buying ETFs. NVIDIA's in over 600 of them, so that's also helping drive shares up 5%. But the news today specifically, NVIDIA putting $2 billion into Marvell technology. This deal really centers on NVIDIA's platform that lets custom chips plug into its infrastructure. And so Marvell designs those custom AI chips for other major tech companies like Amazon. They actually compete with NVIDIA's GPUs, but this partnership kind of flips that dynamic, giving NVIDIA a shot at a much bigger market and then making Marvell a strategic partner for NVIDIA. This investment, though, Scott, is one of many. Just this month alone, look at your screen. You can see NVIDIA has committed $2 billion each to Nebius, Lumentum, Coherent. Before that, $2 billion into Synopsys, $1 billion into Nokia, stakes in XAI, OpenAI, Intel, a couldn't even fit them all on the screen because I only had 5 blocks there. The CEO often reminds investors, though, it's not a chip company anymore, but rather an AI infrastructure firm. Here he is exclusively on CNBC this morning.
The market misses several things about NVIDIA. I think of course, because we are such a large company and we have such a large position of AI computing and all the AI infrastructure, a lot of people might think that all of our growth is all priced in. However, what is very clear is several things happened this last several months, in fact, maybe the last 6 months. We gained share. The number of customers outside of the clouds, the top 5 cloud service providers, has now grown to 40% of our company's business. Most people think that most of our business is in the cloud, but in fact, one of the fastest growing segments is outside of the enterprise, the industrial.
And the man sitting next to him is Matt Murphy, the CEO of Marvell. The argument, though, is that the market is just focused on big hyperscalers, but NVIDIA's ecosystem is just spreading even far beyond them into enterprise, you heard industrial, and now deeper into the supply chain through investments like today's Marvell's deal. Scott?
Christina, great reporting. Thank you. Christina Partsinevelos. Malcolm, I'll come to you. You still hold the stock. I thought what we heard from Jensen Huang on this network exclusively this morning was as clear and understandable explanation that you could ever give from a CEO to an investor base on why the market's been getting this wrong.
Yeah, and listen, I completely understand the standpoint of any investor who says this stock has probably run its course here. It's probably time for me to be taking some profits or exiting the name, because how much better can the story get? They've shown blowout earnings time after time again, and I just don't know how much better you can get than 80% gross profit margin, so I'm going to exit stage left. But I also think that's leaving some opportunity on the table when you consider this company is now an innovation company, is the way they refer to themselves, to Christina's point, not just a chip company. Yes, maybe they're going to give up something on the GPU front when it comes to inference chips, but Jensen's already working on finding his next parade and getting out in front of it, so much so that this company's been investing a lot of its own free cash flow into finding where that opportunity is. So they're trying to grow their next customer in the next industry that's going to take hold, rather than sitting and resting on their laurels where they've got the Mag 7, they've got the hyperscalers as their massive customers today.
Bryn, you own it too. What do you make of what Jensen had to say, and specifically this stock move today?
I mean, it's well warranted. The stock, by the way, it's up 60% over the last year. So it's not like it's been dead money. I mean, Microsoft is the one that's been the dead money. The stock's just resting here. The stock is now on a forward PE cheaper than Exxon and is going to grow earnings 75% this year. It's resting. I feel like this stock eventually will get over 200, which to me, I keep selling calls there because it can't get above that. But I think you will continue to get this stock move like it had last year. It's just resting right now, and then ultimately it'll break out and leave investors behind like it's consistently done. So I wouldn't give up on this name even remotely with this earnings growth that we still had ahead of us and the low PE relative to, once again, an Exxon.
Dan, how much does this market need tech to be back?
I don't think it needs tech to be back, but I think it's certainly going to be welcome. I mean, to Bryn and Malcolm's point, these companies still have terrific growth rates. Obviously, they've been challenged for 6 months, as we've discussed ad nauseum. But the AI story threw a wrench in the work for a lot of names. And no matter how many times these companies say, at least in the short term, we're not seeing any issue, there's a little bit of an overhang. So in light of that, we were, prior to this whole thing, doing quite well without a lot of tech participating.
No, but this is a different environment. So I'll just say the reason I ask how much does the market need tech now. So if you're telling me that, okay, well, oil prices may remain elevated for an extended period of time, even if this ends and the strait reopens, as Pippa was telling us, the flow just doesn't get back to normal overnight. So for the foreseeable future, industrial companies and so many others are going to have their input costs elevated because the cost of fuel and transporting goods from here to there and maybe even manufacturing them in some instances is going to go up. So I can't really bank on the broadening trade right now until that environment changes. So I need now tech to perform better. It didn't have to before because the other trade was working so well. Now it may be impaired for a little bit.
Sure. I'll say a few things. First, I would argue oil will be higher because besides the complications in the Strait, you also the geopolitical risk premium was basically zero before.
Okay.
And while it might go to zero in the long term, when Marco Rubio is president of Iran, in the short term, there's going to be some premium there.
Okay, so I'm going to worry about growth a little bit then.
Yeah, but also the second point I was going to make, well, the first point I was going to make is Exxon was just $100 a share. It's now $175 a share. So you've had a huge run up in these names. So the money, we've seen this in ETF flow, in the EPFR data. Money has gone into the sector all year long and is at some point probably going to rotate out. But the more important point is to your question about input costs, the much bigger issue, for not that oil and energy doesn't matter because it matters for plastics and transportation, but labor costs are still the biggest issue for the vast majority of companies, and wages are still, at least for now, relatively contained. And so you do have an offset there to compensate for the higher input costs.
I guess my point is this. If you had a decision to make, would you feel more comfortable if you believe that oil prices are going to remain elevated and there's going to be still a bit of maybe chaotic aftermath within the Middle East, whether we're there or not? Would you feel more comfortable today putting your dollar into a mega cap tech company or an industrial or a more cyclical company that's more tied to the global economy? Because I think I know what the answer would be, and I'm hard-pressed to figure out how you could answer it differently.
Well, without commenting on what Solis may or may not do, my gut says probably the industrial or the Mag 7. Because, again,
now you want it both ways. Well, he wants his cake and he wants to eat it too, ladies and gentlemen. Finish your answer, then I got to go.
No, now we're going to have to save it for the next time.
Go ahead.
The names have been beaten up so badly, and their growth profiles are still relatively unchanged. Their valuations are super attractive. Again, this is not what I do, so take what I'm saying with a grain of salt, but that just looks pretty compelling to me from an investment standpoint.
Okay, so we'll leave it there. Guys, thank you. Bryn, Malcolm, Dan, we'll see you soon.